Okay, you ready to get started?
Yeah. So once again, welcome everyone. We want to thank everyone for coming. Bobbi mentioned a few minutes ago that what we wanted to do today is talk about our assets. The market is pulled back. Then we had the last 3 days of a giant run up. It's very confusing for small business owners to know how to handle this. And so what we wanted to do is bring in Joey Miller, who's a financial expert, to talk about the state of the economy and give us some guidelines and some, at the high level, some guidance on how we might want to move forward.
Before we get started, we want to thank a couple of people, Dr. Curry Levitt, who sent out a notice to a lot of people, and Dr. Rod Strickland, who is with Fountain of Youth Dentures, for sending out. And of course, By Horizons, who's always been a big supporter of Stanley Institute. We're very grateful for all the reps who sent that out. We also want to give a big shout out to the American Academy of Implant Dentistry, who is helping to get the word out. We're very grateful for that. And also Dinsmore, which is the employment attorney that we had on earlier in the week. Dinsmore.com is where you can get information on them. I do want to give you an update that Lyra, the attorney, reached out to me personally to tell me we've been talking about this new law that's coming into place on April 2nd. It's called the Family First Corona Response Act. It's the one where you have to pay medical leave and family leave to your employees if they're still employed. The bill says that it's enacted on April 2nd, but when you go to the Department of Labor website, it says April 1st. So we're not sure if it's April 1st or April 2nd. She wanted to make sure that people knew that. So if you're planning on putting things in order in your office for your team members, she suggested you do it before April 1st because the wording and the date is just unclear. And there's so much that's unclear right now. We just don't know. And answers are coming out every day. We're waiting to see what the president's going to do with the stimulus package that's going to help small businesses. We know that we've been promised that we could get up to 2.5 months of payroll paid through a small business loan that will possibly be forgiving in the form of a grant. And so what they've asked is that we get together the average of from last year's payroll and then times it times 2.5 to know what that number is. And then also they're willing to pay your rent and then some other rent or mortgage and some other expenses. So you guys start getting those numbers together now. Look at what your monthly expenses are, because when we have more information on this, we're going to have you guys going to your bank and asking about this small business grant, not a loan, a grant from the government. And we're expecting that to come through any day. My bank, Pinnacle Financial, is working with me very closely. They're going to let me know right away if and when that happens. I know First Citizens is also a bank that's been directed to be able to give that grant. So you guys reach out to your bankers, ask them about the small business grant that's coming out that will help you pay 2.5 months of payroll to your team members, also your rent, mortgage, and some other expenses.
Yeah. Just to reiterate, typically when we're talking about our sponsors in a way where we're saying these products are very good. These are the products that we use and we recommend them. In the last week, we've been doing these complimentary webinars for the sole purpose of just sharing information with our colleagues, and our sponsors have been extremely helpful at helping to share the email distribution of these invites. So we want to thank them for doing that, including Joey Miller. So as we transition to letting Joey talk, I want to say that we've been working with Joey and his organization for over a decade now. And those of you who have come to the Stanley Institute and have taken our courses, you understand that we work under a couple of different tenets. And one of those is to reduce risk. And we're constantly looking at valid scientific evidence, information that helps us have better outcomes. That's it in a nutshell. Solid information that gives us better outcomes. And by doing that, we reduce risk. And when we met Joey's financial approach to the markets is very, very much in line with how we treat and how we teach in our institute. So it comes as no surprises that we've worked very closely with Joey in the last 10 years because of his approach to the markets. And after this State of the Union and the next state of the economy here in the next few minutes, I think you're going to understand exactly what we're talking about. Feel free, as we're going, to send in your questions through the question and answer. If you scroll to the top or the bottom of the Zoom window, a pop-up menu will pop up, and there will be a Q&A section, and there will also be a chat section. And you guys are welcome to use both. What we're going to do is let Joey take it from here, and we'll go ahead and tally up the questions. And then what we'll do is at the end, we'll do a question and answer so everybody can get their answers. So with no further ado, I'd like to introduce Joey Miller.
Well, thank you, Rob, and thank you, Dr. Bobbi. It's a privilege to be here. I know right now in the economic state, there's a lot of questions. People are curious about news reports they're getting. The flood of information is running out there from all faucets, and there's a lot of misinformation. There's a lot of concerned individuals, and as I go out there and talk to clients, the questions we're getting in abundance are, how long is this quarantine going to last? What are the overall effects of the market? Our business owners are wondering, as I terminate or furlough employees, what effects is that going to have on their 401k plans? How should I manage that? And as we're moving along, I think it's great to put some data out there that I think will shed a light on one, what does this current situation look like in comparison to other events that we've occurred over the last 100 years, not just here in the United States, but as a global economy. And when can we expect a recovery? What does that recovery look like? And really kind of give you some feedback and some material to help navigate the markets as we go on. Now, having said that, this call is for educational purposes. I'm not going to make any recommendations on any specific opportunities. I'm going to talk in generals of opportunities, portfolio diversification. There is risk in the markets, and you should contact your own investment advisor. I am an investment advisor with a broker-dealer called RT Wealth based out of Chicago. And so what I'd like to start on is we run a 10-member investment committee with a couple of outside independent economists, and their whole job is to challenge our thesis. And as we're approaching the markets and we get together, we're looking for the value opportunities in the marketplace, things that are ultimately trading for a lower premium than the stock may be representing in the marketplace. And the three biggest variables as we look at the state of the economy that we're really focusing on is, number one, what are interest rates doing? And so as we look at interest rates in today's economy, what we're seeing is interest rates are ultimately, they've been lowered to the lowest point that we've seen. Low interest rates, if you can imagine as you being a buyer in the real estate market, low interest rates allow a buyer to go out and purchase a bigger asset. So if interest rates are at 6%, which is historically over the last 25 years, that's been the number. Now we're certainly looking at significantly lower interest rates, but what that allows us to do is go out and it gives us certain purchase power. And so if I'm a person that can spend $2,000 a month at a 6% interest rate, that might allow me to go out and purchase a home for around $300,000. Now, if my interest rate goes from 6% to around 3%, which is pretty indicative of where it is in today's world, that same $2,000 might allow me $350,000 of buying or purchasing power. So with lower interest rates, it historically makes real estate more valuable and more profitable. What it also does is it infuses more money into the marketplace, and equities tend to benefit from low interest rates. So when we ask the very first fundamental question, where are interest rates? Interest rates are at a historical low. So that's good for the economy. That's good for real estate. That's good for equities. When we get to the next question, how are earnings doing? How are corporate earnings doing? Are companies hitting their guidance across the board, or are they missing their guidance? We're going to come back to that in just a moment. And the third question that we ask when we're viewing the economy is, are there companies going insolvent? Are there companies going into bankruptcy? And again, we're going to touch on that as well. And so those are the three biggest variables that drive the economic factor and drive the marketplace, and that'll push it higher or it'll pull it back. As we're in this quarantine, and some of the biggest questions we're getting is how long is this going to last? And I mean, there's not a shortage of information on theories and opinions about that. I think it's interesting that the most latest conversations on that very matter, Governor Cuomo last night said, you know what, I probably shouldn't have quarantined everybody. That was probably a mistake. That actually very well could have led to an increase in cases, that we're currently dealing with and we're going to deal with. His view last night in an article I read about, midnight last night was, I should have quarantined those having health problems and those of a certain age demographic. And I should have allowed other healthy younger people to go out and keep the economy moving. I would have been separating, healthy people from people who are potentially more exposed to this virus. And that separation within age and health might have been a better avenue rather than just lump summing everyone and saying to everyone, go home together. And so what we're seeing is a shift in policy, and it's almost changing on a daily basis. President Trump did come out and say that, hey, come Easter, I want to start allowing this quarantine or restriction to start opening up in certain areas. And so there's a lot of conversation right now on, potentially labeling certain areas as, high degrees of areas of further restriction needed, and certain areas that are of low concern or lower concern, and allow those areas to start to get back to work. And so I do believe, and that is the direction we believe things are going to move. Areas with lower population density are probably going to see a release and a flexibility in working status and quarantine. And so we believe that is the trend going forward. That ties right back into what are corporate earnings going to look like? And so we anticipate corporate earnings across the board are certainly going to be impaired this year. It's no doubt that most industries, most sectors are seeing decreased spending. If you just an idea about what that looks like, the U.S. GDP is about $700 billion a month. And so when you kind of put the brakes on a lot of different industries, it does slow down that GDP, and it does create a scenario where many sectors are going to see lower corporate earnings. And so while we anticipate that, it brings us to our third question of corporate. You're talking big S&P 500, and mid-cap 500. We're talking insolvency, or are we going to have some bankruptcies? Now, what's interesting about those two questions is an unprecedented event has happened. We have the stimulus package to the tune of $2 trillion. Just to put that, in perspective of kind of what does that mean in regards to corporate earnings, corporate default, and past analysis. The worst case scenario in the last 100 years that we have as a great reference point as far as to the effects of this current virus is the Spanish flu. And that created far more deaths, it spread far more rapidly. And the overall effects of that were, in today's world, about 5% of GDP. And so to put a number on that, that was about $400 billion of total global costs using today's valuations. So to put that in context, what the government has done is use the worst case scenario and then multiplied it by 5. And that's the amount of money they're pumping into the marketplace. They didn't just come out and address the potential loss. They quadrupled it. I mean, they increased it so significantly to put money into the economy, to prop up businesses, to assist in all areas that are going to allow our overall economy to thrive and to get back to work as quick as possible. And so that is a massive number. Now, as we look at the stock market and we see this 38% sell-off at its worst point, today I recognize it's around 26%. A lot of people are concerned, should I go to cash? Is now the time to run out of the market? Our thesis is that that's not the case. The fundamentals of the market have been on a tear. They've been very, very strong. And was the market due for an overall pullback? Probably, without a doubt. Is this current pullback in comparison to the fundamentals that are currently playing out? No, this was an overzealous, emotional, panic sell-off. And Dr. Bobbi, I know when you and I go shopping and we're noticing stuff at 30, 40, 50% off, we're not doing a whole lot of panicking. We see that as a buying opportunity. And so, our best guidance would be, again, as you're visiting with your investment advisor, with this most recent sell-off, this is not the time to panic. This is a time to get somewhat excited. There's been a reset of fundamentals and values in the marketplace, allowing for things that might have historically looked expensive in regards to their fundamentals, their values, are looking very affordable. Now, are there areas that probably should be avoided? Absolutely. As a guideline, I always avoid airlines. I have my entire working career. It's an area I don't like to invest in. They have been one of the more volatile areas of the marketplace, and that goes back a lot of years. Are the cruise lines going to recover? I don't know, maybe. Hospitality is also another place. When I say hospitality, I mean restaurants, I mean hotels, and that would also include the cruise industry. Not areas I like to invest in. They're heavily affected, and when they're affected right now. Unlike an apartment that might rent out month to month, or an office building that might sign a contract for 3 to 5 years, a hotel is day to day, and it is quick as one day goes by. That's as quick as their vacancy, is being managed. And so, those are areas that are going to be heavily affected. We hope that those industries recover quickly, but those are areas I like to avoid. And so we do anticipate, as quick as this market drop, we do anticipate a quick recovery. However, I say that with a word of caution. There is going to be volatility. When I say volatility, I mean fluctuations in the stock market price. Big up days, big down days. But overall, the fundamentals of the marketplace are being driven by the reality that we've had 10 very strong, robust years. We have a stimulus package that is massive in size, and the scope and the flexibility of the outreach that's going to have. And so we really do believe that will help sustain many businesses that would have been rather problematic without it, and really allow us to work through this current virus and allow things to, I can't say be business as normal, but the new business, we do see a rebound in the short term. So State of the Union, interest rates look good. Earnings are certainly going to be affected. As far as bankruptcies, that remains to be seen. The stimulus package is doing an enormous amount to prop up corporate America, and not in just obviously large companies, small companies across the board. And so, and the size and scope of it is again 5 times bigger than the worst global event that we've seen. One of the bullet points we also put out there was, is the news helping? And for most of my working career, and I've been in the world of investments for 20 plus years, I read reports, and it really doesn't matter what report or what site I go to. There's guys like Jim Rogers, an extraordinary futures trader who's been Mr. Doom and Gloom, casting a crash of the market for my entire working career. And this most recent strong bullish rally of unprecedented 10 plus years, along that time frame, there have been short funds and naysayers, and so what we're seeing is a lot of news driven reports that tend to get very emotional to sell reports and to sell marketing. And we at John Galt Wealth Solutions, we really focus on truly just the bare bones fundamentals. And so for the most part, I will tell you, I read my reports before the market opens. I read my reports after the market closes. And if I'm watching a news media outlet, the volume is off. I don't want to hear what they have to say. They're not fund managers. They're not economists managing money. They are people selling marketing ads and driving people's emotions left and right and all over the place. And it's enough to get pretty maddening. And so, you know, for the most part, I think it's important to read up and read all of the news on the investments you're looking at, read all the fundamentals and the economics based on the health of the country. But for the most part, you know, we read a lot of news reports, and they always come in after the event, really driving human emotion. And that emotion is historically the one thing that drives people to make poor decisions. They'll read a really negative report. They'll want to run into cash at normally the worst possible moment, when the market has been beaten up, when Dr. Bobbi and I are getting excited to go do some buying at some great value propositions. You know, humans in general, using emotions to approach the stock market, are buying and selling at the worst possible times. So for the most part, you know, our advice is, if you want to watch the news, just turn the volume off. It'll go a lot further. Then you're getting just the hard statistical data of what the stock market is doing, what companies are doing, and so we like to turn that off. You know, one of the cyclical trends that we talked about, I wrote a book on seasonalities, and this is really interesting. Dr. Rob, I know you'll appreciate this, but in 13 of the last 15 election years, the last 7 months of the election cycle, which is an area that we're certainly coming into, 13 of the last 15 of the last election cycles, during the last 7 months, the market has been bullish. And so we're approaching a time frame where President Trump is,
Joey, just bullish meaning what?
Yeah, the market goes up.
Okay, thank you.
Market is moving in the up direction, increasing in value. And so with President Trump running for re-election, he kind of, you know, he's the one driving the car, you know, for the most part. Now there's a lot of levers out there, and there's a lot of other people involved. But for the most part, he gets to focus on a lot of the economic policies during a time frame that he's running for office. And so it's no surprise that he is going to want to aggressively get things back on track, because it's to his own benefit. And so that's been the case 13 of the last 15 presidential election cycles during the last 7 months, when they're either running for re-election. And so we do factor that in, you know, and that fact is not lost on us. One of the things we also sent out as a bullet point, and then I've got some business, items I want to go over that will certainly be of value to you guys, is what does this recovery look like, and when might it happen? And so there's certainly a lot of moving parts, and there's day-to-day updates on how the coronavirus is being handled. It's our opinion, based on most recent news, based on positive drug trials, based on a lot of positive effects we're seeing, that while the virus is not going anywhere anytime soon, and it's working its way through the population. In fact, I think most of us are probably touched by it from a friend, family member, or certainly maybe a friend of a friend. You know, I would say as we fast forward a couple weeks, we're all going to know somebody. It's certainly already affected my life, some of my friends. But what I can tell you is what's being reported is about 10% of the active cases. There's probably 90% of the cases of people who are having very mild symptoms. That's the case in a couple of friends of mine that are told not to go to the hospital and not to get tested. And they're being monitored, and should they have lung impairment, that's when they're told to go to the hospital. Meaning that we've got, I think, 80 to 85,000 cases as of last night. And there's another 90% at home in various stages of recovery. There's also a large part of our demographics. And it seems like at least a quarter of the people I talk to will make the statement, I think I've already had it. I think I've already worked through it. And they'll discuss some unusual ailment and conditions. And so I do believe there is a large part of our population's already worked through this. And as it continues to run its course, it does seem like the current administration and various governors are saying, hey, we do believe that there are hot areas of high concern. And there are other areas that don't have the population density, and we want them to start getting back to work. So as far as the American workforce, we do believe we're going to see a release of quarantine in coming weeks that is going to put part of corporate America right back into work. If you're in downtown New York, it's probably going to be a couple more months. If you're, outside Portland, Oregon, you're probably looking at going back to work here pretty soon here in the next couple of weeks. And so as far as the equities or the stock market is concerned in regards to an increase in value, we just got through 3 pretty bullish days where the marketplace closed higher than where it opened. The global market sold off a little last night or went down. And so we do anticipate a slow return to, true fundamentals. Where's the marketplace going to close this year? We don't have a crystal ball, but given the fact and the reality that the marketplace has sold off, we are certainly seeing more room to the upside than the downside. Again, that's our opinion. Contact your own financial advisor about your personal situation. One of the other bullet points we put out there is what is smart money doing? There are 3 basic asset classes. We believe that you need all 3 asset classes in your portfolio to have a truly balanced portfolio. Those 3 asset classes are the equities market, and we'll include bonds with that as well. Fixed income markets, things that pay monthly income, and there's structured notes. There's different debt instruments like mezzanine debt and different funds out there that provide monthly income with, a CD would be a debt, that type of fixed income product. And real estate investments are all alternative assets, and those certainly aren't suitable for everyone. Again, contact your own investment advisor to see if those are suitable for you. But we like all 3 asset classes. Last year, the equities market obviously took off in a tear, 28% up. In general, the real estate market did not perform to that degree, but they had an incredible year. This year is just the opposite. Currently, equities stock market is certainly trailed off since the beginning of the year. Well, and with this decrease in interest rates, real estate looks very, very attractive. And so if you have all 3 of those components in your marketplace, in your portfolio, you've got an advisor advising you what markets look great. We believe that you're sitting here in the marketplace right now, and you're not seeing anywhere near the same sell-off that a lot of people are seeing in the marketplace. And so we believe it takes all 3 of those tools in your toolbox, in your portfolio, to approach the marketplace so that you have assets that are gaining in value when other assets might be currently displaced. And so that's our approach to the marketplace. And what we're seeing is smart money is certainly balancing their portfolio and diversifying accordingly. One of the other big areas of concern in the marketplace is the sell-off of crude oil. It's not that long ago that we noticed that a sell-off of crude oil or crude oil getting less expensive or going down in value was a positive event for the equities market. People would benefit from seeing, cheaper gas at the pumps, and they'd be able to take that excess money and put it in other areas of the stock market. Ironically, in today's world, given the fact that we are a mass producer of shale and our fracking, and especially in the Permian Basin here in Texas, is that this sell-off of oil is hurting the U.S. GDP. So we're seeing oil at unprecedented levels that we historically haven't seen. And so obviously with the airlines down, consumer traveling down, cruise lines, there's certainly been less consumption. That's a short-term event. And Russia and Saudi Arabia have been arguing about who can produce more crude oil, and they've been in a price war as well. So I do want to touch on this just for a minute because it's something that is driving the markets. It is a variable, and what do we think it's going to do? If you look at the current price, when crude oil is at $40 a barrel, and just to give you some historical numbers, Saudi Arabia really needs crude oil to be around $70 a barrel to not only balance their budget, but to grow their GDP, their gross domestic product. Russia is a low-cost producer. They can profit very, very well at $40 a barrel. And so what happened a couple months ago is Russia said to Saudi Arabia, hey, let's start decreasing our production so we can drive up the price. It benefits both of us. Saudi Arabia said, absolutely, I agree, sounds great. And then they increased their production. At the same time, that we came into this global crisis of the coronavirus, and consumption decreased. And so we kind of had two different things hitting crude oil at the same time. So one might ask, who is the biggest loser? Is it Russia? Is it Saudi Arabia? Or is it the United States? In the short term, it was the United States. $20 to $25 a barrel crude oil is not great for the United States. But to put this in perspective, Saudi Arabia depends on crude oil for their GDP, for the profitability. It's about 70% of their economy. And right now they're sitting on about $500 billion worth of reserves, which is about 35% less than where they were sitting 5 years ago. So their reserves and their GDP is going down. Russia, on the other hand, sitting on about 600 billion, and they're down about 25% over the last 5 years. And the United States, it's about 8% of our economy. So it's about 70% of Saudi Arabia's economy, 40% of Russia, is about 8% of the US economy. So in the short term, it certainly affected us, it hurt us. In the long term, it's going to be far more damaging for Saudi Arabia specifically, Russia, than it will be for the United States. We have a lot of other industry. And so we do anticipate higher crude oil prices in the near term, and certainly as things go on. And so that's something that is certainly moving these markets around, and we think that the fundamentals of that will give some benefit to the equities market as well, as these trends tend to normalize. And so the fundamentals in the short term, we expect that volatility, that up and down movement. In the long term, we do anticipate a higher market, and that's certainly how we are positioning ourselves, is taking more exposure to benefit from that upward trend that we anticipate. Now that's pending, developments that are unforeseen at this point in time. We do need to keep an eye on corporate earnings and see how well and how smoothly the paperwork and the process goes to get money in the hands of small businesses and to their employees. Dr. Rob, you and I were talking about practices that may have employees, one, either terminated, or two, maybe furloughed, what that means to their 401k. Do they need to cancel it and restart it? What paperwork is needed? If you think of a 401k as its own individual entity, that entity is going to be live and active as long as you're doing your required paperwork and filings every single year. It's its own instrument, its own vehicle. Now, the participants of that vehicle, that's kind of what we're talking about right now. Nothing needs to change with the structure, the plan, or the entity. The participants have changed recently. A lot of people have been, terminating employees so that they qualify for extra relief. And if that is the case, the employee has a couple of different options. One, since they're terminated, they can take their 401k money and they can contact an investment advisor of their choosing. And they can roll their money from their 401k into what's called a self-directed IRA. And so it still remains tax deferred. And in many cases, that can be a great strategy to open up the entire world of investment opportunities, where a 401k oftentimes has restrictions as far as how you can invest it. A terminated employee can take their 401k and they can roll it into a self-directed IRA with an investment advisor and follow the investment plan that advisor sets forth that meets their goals and requirements. But they are opened up to the entire investment world. So that means they have a lot more opportunity, they have a lot more flexibility. And for a lot of employees, that's a really big benefit. Some employees will probably keep it in the plan, and should business return to normal in a reasonable time frame, their plan just continues as normal. As far as you, the administrator, if you have a plan set up, what do you need to do? It's just a matter of filing your paperwork, that termination paperwork, and then when you rehire that employee, should you rehire those employees, that will be a new startup, if you will, into that employee. You have 45 days to make that decision, so it's not it's not an immediate decision that you have to make, but after 45 days of a terminate, if an employee doesn't come back within 45 days, they will need to move that money out of the plan and into a plan of their choosing. If it's within 45 days, nothing is needed. They can stay as usual and continue with that plan. Now, let's just say that this goes on for 70 days and you've terminated employees and they have rolled their money out and then they're rehired. They do have the option of rolling that money back into the plan, that 401k plan, if that's where they want those funds to be. So ultimately, you, the owner of a business, don't have to do anything. You have to keep your regular filings for that plan. Your participants, if they're rehired, you're going to need to fill out some paperwork if it's after 45 days for a new hire. If it's less than that, then they can stay in the plan and just be re-engaged back into the 401k plan. I'll also add that as a business owner, a lot of people will have criteria that say you don't qualify for a 401k plan, until you work 1,000 hours. Now, obviously, if you've terminated an employee, you can also add an addendum to your 401k plan to forego the 1,000-hour requirement if they've already been a long-term employee with you, just so they don't miss out on qualifying for a 401k plan should you rehire them after termination. And that does include your defined benefit plan and your profit sharing plan as well.
So
That's
Joey,
good information.
yeah, I was going to say that could be the nicest little pearl that we've heard with respect to this struggle that we're all dealing with so many of us in the small business arena have had to let team members go in order to allow them to qualify for these federal aids and to reduce our cash obligations, our cash flow obligations. But to summarize, typically, if I've got this right, typically the 401k programs that we have are limited in what we can allow our employees to invest in. And if they were to roll that out into a self-directed IRA, it gives them more flexibility and gives them the ability to invest in a greater diversity of opportunities. Is that correct?
That's 100% correct. Yeah, in fact, in many cases, it's one of our strategies working with business owners is how can we access 401k capital, which is monitored by the Department of Labor and has a lot of extra restrictions. How can we move those funds into a self-directed IRA world? And you have far more possibilities you can of investing that money. In many cases, we use those funds for real estate or other avenues that give them a lot of other extra opportunities. So yeah, that is one certainly a silver lining for the employees who want to be active in the management of their assets.
Joey, I do have a question for you, and I'm going to have to read it verbatim because it's a very good question. With all the stimulus and quantitative easing and repo operations, how do you address the impending inflammatory, possibly hyperinflammation that will occur after the deflammatory cycle? You want me to read it again?
Yeah.
He's he's asking the question, are we looking at hyperinflation in the near future?
Right.
It's hard to have hyperinflation with zero interest rates. They historically don't go hand in hand. So when we think of hyperinflation, we think of prices of goods and services increasing in value. With consumer spending down, I think what you're actually going to see is the polar opposite of that. I think in the short term, you're going to see more motorcycles, more jet skis, more side-by-sides, more toys up for sale online. I think you're going to see, some people are going to look at a choice between a new car and a used car, and they're going to purchase the used car. So what I'm saying is that a lot of the extra spending within the marketplace is probably in the short term going to decrease. So Ford, S&P just downgraded Ford to junk status. And so me as a Ford owner, I own 2 Ford trucks. I can tell you that their next move is to have competitive pricing, a decrease in pricing. different deals, 0% financing, incentivizing people to go in and purchase a new Ford. And I believe that's exactly what we're going to see. What's the first thing the airlines did at the early onset of this panic? If you want to have your own private plane right now from Portland, Oregon to to various places across the United States, it's a $200 ticket, and there's 10 of you on a plane. And so what you're currently seeing is a deflation in prices. You're seeing price wars going on across the board. I just bought a coffee this morning, and lo and behold, the special of the day is a large coffee for $4, where before it was $5.50. So I think what you're going to see is the polar opposite. Is you're going to see a short-term deflation until consumer spending normalizes and creates and disincentivizes those price wars in almost every sector. I mean, you as business owners, is this the time frame that when business gets back to normal that you're going to choose to raise your prices 10%? Probably not. You're probably saying, let's fill up the schedule, let's fill up the books, let's get everybody back to working, let's get back on our feet. Let's go buy like 5 extra cases of masks because that wasn't fun the last time. And so I think what you're going to see is a short-term deflation. And, I don't see this hyperinflation just based on spending habits and other things within the sector.
That's good news. I have 2 more questions relating to the 401k. Hey, Beth, I'm glad you're on. So Beth asked if her team members roll over, if she's terminated her team members and they roll over their money from their 401k and then they come back, would they start all over with the team with the 401k, or is this a disadvantage to them? Now, my experience has been that if a team member came back and joined me and they were qualified before and that 401k policy was still in place, they're still qualified and they just pick up where they left off, whether their money's still in there or not. Is that still true, Joey?
Yeah, ironically, that's where it becomes a little discretionary. So Dr. Snyder, great to have you on the call. Yeah, that's where it becomes a little discretionary because, I would say if you follow the law of your existing document, what it probably says is when you terminate an employee, they're actually terminated. When you rehire that terminated employee, they're almost like a new hire. And so your plan and Dr. Bobbi, your plan is written in a format where you, as the administrator of that plan, can forego the 1,000-hour requirement. And if anybody does not have that in their plan, that is a 10-minute step, which I think probably every business is going to take to forego the step to qualify for a 401k plan.
Yeah, I agree.
Yeah, but there are certainly benefits to people who have the ability of self-directing their 401k, rolling it out, and then restarting that same 401k at a future date. Okay.
And then there's some questions as to if a team member is laid off or furloughed versus terminated, what do they do in regard to that 401k?
A furloughed employee is considered an active employee. So there's no termination of their 401k. And so that is going to be regarded a little differently. So a furloughed employee is simply, hey, you know what, take some time off, but they're still a legal employee. Therefore, they cannot roll out their 401k unless they're, of the age of 59 and a half, then there is an exemption. A terminated employee certainly can, however.
Okay.
And then if they're laid off, is that considered terminated also?
Laid off it would be the same as furloughed. They're still an active employee.
Got it. Okay, great.
Okay.
Great information. Hey guys, something we ran across last night, I don't know if you know, for the dentists who are on the call, Henry Schein has actually purchased the ability to be able to release tests where you can test to see if you're immune to this virus. And the thought process is that if you're immune, then you can go back to work and keep pumping the economy. And Dr. Rob and I just think it's really ironic and awesome that Henry Schein is one of the big leaders behind getting these tests out to see if you're immune. You want to say more about that?
Yeah, it looks like they have the ability in the article that I read to put out about 250,000 this month, and then they're looking to ramp up production for next month. The neat thing about the test that they said is also it's a 15-minute test that can be administered by us in dental environments. So it's a finger prick, very similar to a diabetes sugar level test. So very exciting. Nice to see Henry Schein coming through for something bigger than dentistry.
Yeah, it's very exciting. We have no idea what that's going to cost or how to get those tests, but it's in the news. So you guys keep up with it and take a look. Also, earlier in the call, if you weren't on there, I said that this new act that's coming in place, the bill says April 2nd, but the website, the Department of Labor website said April 1st. One of our viewers did say that there's been a correction on the Department of Labor website. So there is a great question and answer site about that act, because there's a lot of questions about whether I should lay my employees off or not, and do I have to pay for medical leave. There's a great question and answer section on the Department of Labor website for that. So if you guys want to go there. Do you guys have any more questions? Joey, do you have anything else to give us? I feel like this has been all great news. From what I understand from what Joey's saying is, now's the time to hold steady. Don't sell out, and let's just let the market come back, because, or even buy in. Now's the time to buy in. And it sounds like our economy is going to recover and things are going to be positive. And that's what we all want to hear. We want to hear that things are going to be good.
So Joey, go ahead, Joey.
Oh, I was just gonna summarize. Anybody that has any personal questions that relate personally to your situation, again, we're available to help answer those questions. But I would encourage you to definitely contact either us or your own personal financial advisor. They're gonna be able to help guide you as to the best direction for your personal situation. For most people, there is no one answer for all. But when looking at the fundamentals, we are optimistic. We're seeing a lot of positive signs out there and a lot of great opportunities in different sectors. And so again, I would strongly encourage everyone. This is not a market to panic from, not a market to hide from. There are a lot of opportunities in different areas of the market, and certainly in different sectors. And many of those just got a lot less expensive. And that makes the fundamentals and the value of those certainly put us in a position to acquire some of those. I mean, and so yeah, we're happy to help answer any questions that might relate directly to you. You're happy, more than welcome to reach out or contact your own personal investment advisor.
A couple more things before we go.
So the first thing is, thank you, Boyd. Boyd is a vice president for BioHorizons, works with Henry Schein. And he on the chat here, if you can't see it, let me just read what he wrote. He wrote that the test has a waiver for medical right now, but does not yet have a waiver for dental. So when I misspoke a second ago when they said that we will be able to administer it. For now, we don't have a waiver, so we can't do it at this point.
Joey, here's another question. Is it possible for me as a business owner to roll over my 401k into a self-directed IRA?
There is a age exemption, which is 59 and a half. If you're under 59 and a half, the answer is no. As long as you are still employed, and as an owner, you're still employed. You might not be paid. You might not get a paycheck right now, but no. But there are other avenues for you as the business owner. I would love to have that conversation in private. Reach out and we can talk about other options that you can do. But no, it's as a business owner, as a sole business owner, it's really hard to fire yourself. However, there are adjustments you can make to the plan and amendments you can make to give you more flexibility.
And then a couple people are asking, when should they start buying more in the market? Is now the time?
I would say happy to have those questions one-on-one about that person. It's hard to make a general answer, not knowing somebody's personal situation, but happy to answer that question one-on-one, or again, contact your own personal financial advisor, investment advisor, and they can look at your portfolio, look at how you're currently positioned, look at your current exposure, and certainly discuss what's suitable for them.
Okay, and I do want to answer a question. Someone asked, can a furlough or laid off employee that's not terminated still collect unemployment? In North Carolina, they can. What they're asking them is if they've had a reduction in hours or if they've been terminated or laid off due to the coronavirus. So every state's different. Check with your state, but as it stands now with North Carolina, from what I'm hearing, you can. Joey, if people want to get in contact with you personally, how can they do that?
Yeah, johngaltwealth.com is our website. Our office number is on there. Our emails are on there.
So it's John Galt, G-A-L-T, wealth.com, johngaltwealth.com. And I would advise you guys to reach out with Joey. He has so much information and he can guide you. We've been using him for years. We trust him. He's engaged in the market and he understands it in a way that we don't. And one of the things that we were told a long time ago is that let the people who know what they're doing do what they do best. And that's what Joey knows. He knows the market. He knows investments. He knows real estate. He knows alternative investments. And so, we don't, at least most of us. So I turn to Joey when Dr. Rob and I want to do want to be financed and set up our retirement in such a great way that we can retire at a great age. Another question. Can a spouse who works for a dentist collect unemployment after being terminated or having hours reduced? Again, that's a state-by-state basis, but a spouse is an employee. So as long as they're not an owner, then the answer is yes in North Carolina, but it is a state-by-state basis. So reach out to your unemployment office. And guys, let me just say, Dr. Rob and I, the advice that we're giving you and like what I just said, is only stuff that we've learned. We're not financial advisors and we're certainly not attorneys. There's a great employment attorney office that we have been in contact with. We spent over 5 hours one-on-one with them. The name is Dinsmore and Sloan. And if you need answers, they have answers on their website. It's dinsmore.com, dinsmore.com. They have questions and answers on their website about what you could do and what's legal to do with your employees during this time. And if you want a one-on-one with them, they'll be happy to sit down with you for an hour. I think their rates are somewhere around $500 an hour. So, reach out to them if you want to know what's legal in your state. I wanted to know what was legal in North Carolina because it differs from where some of you guys are. Reach out to them, get on the phone with them. It only takes about 30 minutes to get your questions answered, sometimes 15 minutes, and get the real answers that you need. So again, if you need Joey, it's John Galt Wealth, johngaltwealth.com. Is that right, Joey?
Yes, ma'am.
johngaltwealth.com.
And we'll have that on our website as well. So you can very easily get in touch with him if you want to.
And this is being recorded. So if you have friends who are on other webinars or who cannot jump on today, please share this with them. It'll be on our website, which is stanleyinstitute.com. We'll be happy to share any additional information. So if you want to reach out with me, my email is drbobbi, DRBOBBI @stanleyinstitute.com or Dr. Robert @stanleyinstitute.com. And many of you know that if you reach out to me, I'll get right back to you. If you reach out to Dr. Rob, it may take a few days because he doesn't sit on his computer as much as I do. So we're here. We're willing to help you guys. We're all in this together. We're going to get through it. Today is a lot brighter than this past Monday was for me, and I'm seeing the light at the end of the tunnel. Wake County, which is where I am in North Carolina, just did a stay-in-house order and for 2 weeks, and I still feel very positive about where we're going to end up. So I think it's going to be great. I think in the end we're all going to come out great. So just let us know if we can help you. We're here to help you. We're going to try to do another webinar next week, so stay tuned. We'll let you know what that one's what's on that one.
One clarification that just came in. Dr. Bobbi had said that the test for immunity, the test for antibodies that show that you either have had the coronavirus or you currently have the coronavirus, but it does not tell you that you are immune. It just tells you that you either have it or had it, but not necessarily immune. We don't know at this point if the virus can mutate and you can get it again, or if you can there was one report that someone had actually gotten this twice. So just to clarify that. Yeah,
there's a lot of unknowns still, but we're learning more and more every day.
Thank you so much. If there aren't any other questions, we're going to go ahead and wrap it up, and we'll be in touch next week with hopefully we'll get back to talking about dentistry.
Fun stuff.
Not the business side and not the financial side, but back to how do we place dental implants in my world extremely efficiently.
Yeah, let's get back to having fun. Thank you, Joey, for joining us.
Thank you, Joey.
Oh, thank you, Dr. Stanley. Dr. Stanley.